All right. Good morning, everybody. Shoot me a answer if you can hear me right now. Perfect. All right. Welcome to the Hurley Investments Trade Findings and Adjustments this morning of Thursday, January 27th. Good to be with you all this morning. Today, just to get right into it, I'm going to go over a little bit more on put options that we lovingly call our protection and our insurance. The part of what we do that allows us to protect stock ownership so that when, and it will usually be when, right? Stocks fall, because they always fall at some point. And we've developed this strategy over years of doing this, where we're able to acquire more shares on some of these drops. You can kind of see that this is our stock market. So our drops here, they happen all the time. But this gives us an opportunity where if we can protect at a higher level and have the ability, after a stock has fallen, here's our Apple stock, fallen from 180, 175 range down to 160, now at 162. Let me update this. Gives us the ability where if we protect it up here at 175 or 170, we now have the right to sell our stock up at 175, or we had this right, as soon as we purchased that put option. Now that we're down here at 162.26 as of this moment, that put option has gained value because the contract says we have the right now at any time that we want to sell our stock up at 170, 175, depending where we bought that protection, right? So for those of you coming in new, see a few new names I don't recognize, which is always great. We're just going to go over some of the basics and then go over a real trade and discussion that Kevin and I had this morning, as chance would have it, with Apple. So just to go over some basics, last time I went over call options. I'll probably have to do that again because I feel like I could have done a little bit better, more simple explanation. So we'll be going over the coming weeks, the 4 option instruments. We went over call options, which if you missed that, don't worry. We'll hit it again at some point. Today, we're going over the put option. Again, this is our protection, our insurance, our protection for stock ownerships. So what does a put option do? Some of you guys, you've been here a long time. You know what this is all about. So just kind of bear with me for a minute as I help out some of our new folks. Put option gives us the right to sell stock for a certain price. And I'll say at a certain price. Makes a little more sense. Heard me talking up here about 175. We have the right to sell Apple shares at 175, and it falls down here 160, just look, 160-ish level. At any point we can sell it at a higher price, up at 175. So With that said, when does a put option increase in value? And some of you guys that have been here a while, you can answer this pretty quick. When does a put option increase in value? Great, thanks, William. Increases in value when the stock goes down. Stock price, I'll say. So every stock that is optionable, that is, it has the ability to purchase options on that stock, you can do this with. Some stocks don't have options. Most of your big companies, most of your important companies will always have the ability to purchase options on them. These rights to be able to sell stock, or if it's called a right to buy stock. So these contracts trade, these contracts of options, they trade kind of like a stock where you can buy them and buy these rights, or you can sell them and offer the rights to somebody else in exchange for being paid. So reason would have it, if put options increase in value as the stock price goes down, then obviously it loses value when stock prices go up. So how do we know what price we have the right to sell our stock at? Leaning again on you, more experienced ones. Yes, thank you, William. William for the win again. You can sell at the strike price. There's different strike prices that you can purchase options on. All that the strike price means is that's where we have the right to sell our stock. So we talked about 175 again. If we buy the right to sell Apple at 175, 175 is now our strike price. What we paid for that right is called the premium. Just like you'd think of an insurance policy, you pay a premium to get certain benefits or assurities, right? So, couple of definitions, these are important. Starting off, strike price, where you get to sell the stock at. Premium price is how much it costs to buy that option contract. Any questions so far? Everybody following along? If I don't get any questions, I'm going to assume things are going well. All right, so we're there so far. Let's keep moving along. Let's see. Here's a quick example, kind of comparing it to car insurance. You buy your insurance contract, insures a certain value. You know, obviously insurance is a little more complicated. There's fine print and all that stuff. Well, options are not like that. Put options, it's very straightforward, but there's some similarities. You pay a premium, your contract of insurance lasts a period of time. So let's say you get in a wreck and your insurance obviously pays for a repair or replace your car to make you whole, right? So now we have, you can see our Apple stock here. Apple, you buy a long put option, protects the value of stock ownership. You pay a premium like we just discussed. Lasts a period of time that you get to choose. So then the stock price falls and your put option, assuming you bought it before it fell, allows you to sell the stock at a higher price. So just to go over some numbers, car's worth 50 grand, premium for your insurance is 1,200 bucks. For 6 months, your car wreck causes $10,000 of damage. Insurance is obligated to pay for repairs to make you whole again. You still pay that $1,200 for the premium that you don't get back, but it's better than losing $10,000 that you'd otherwise have to fit the bill for out of your own pocket, right? All right, back to Apple stock. Stock is worth $100 per share, we'll say. 500 shares you own is worth 50 grand. Your cost for your put option premium is $1,200. That lasts 3 months. Gives you the right to sell 500 shares of stock at the stock price of $100. Again, $100 being our strike price. So in the meantime, Apple falls to $80 per share, and your 500 shares is now worth 40,000. So you can exercise that right that you bought to sell at $100 a share. That's worth, that ability is worth $10,000 because the stock price fell as much from that point. So you still paid that $1,200 for the protection, but so what if we, instead of selling our stock, what if we just sold that put option? I mentioned a little bit ago, you can sell options similar, you can buy and sell options similar to how you buy and sell stock. So let's go over some math. What if we were to just cash in that put option, get that $10,000 of profit, and what if we then went and bought more shares down at a lower price, in this case $80? So we're at 10,000, we take out our $1,200 of premium, and we've netted $8,800. So what can you do with $8,800? Divide that by our current price of $80 per share of Apple shares, and you get the ability to buy at least 110 new shares with that money. So you buy 100 new shares, you now have 600 total shares. Keep following along with me. Cashed in that put option, our insurance, instead of using the right to sell, because it's gone up in value as the stock has gone down, we're just taking advantage of that increase of value, and we're simply dollar cost averaging, keeping our average cost low by buying at lower prices. But we do it without having to come up with more cash of your own, trying to find cash to move from a savings account into your brokerage account. We did it all through protecting stock ownership. So now we have 600 shares. So let's go back and look at that premium. That $1,200 we paid it for the put option premium. You divide that by our share, our total amount of shares we have now, since we have 600 instead of 500. Divide that by 600, leaves us 2. So what does that mean? $1,200 total for the put options divided by 600 shares gives us $2. So this is simply our break even. So the stock needs to move up $2 to $82 per share to hit break even for us. So if we had just been in the stock, we had 500 shares, we'll say, up at $100, it moves down to $80, we're simply out that amount, that $10,000. We have to wait for it to get all the way back up to $100 from $80 in order to hit our break even. That's if we only had the stock. But if we can take advantage of a situation like this, protect up $100 a share, now when we cash in that put option, we only need it to get up to this $82 a share. We only need Apple to move up to $82 just to hit our break even. So everyone else needs to wait for Apple to get back to $100 to hit break even. And when we get back up to $100 a share, how much is it worth? 60 grand. So we've netted 10,000 by the time it gets back up to $100 a share, instead of just breaking even. Guys, this is about as simple as I can make it. Now that you understand a little bit about how they work, let me go over some things we did just this morning. So, let's see, I did want to show you a few, let me zoom in here, a few examples of put options increasing in value. Let me move this guy up. I don't know if you guys can even see this, but try and make it a little bit bigger. Hopefully you can see that a little bit. So this was just a couple days ago. This is Walt Disney Company. When everything was kind of falling off, our shares up here, equity, these are our shares, was down $45,000. And you can see there's a few different put option contracts here. that had protected it that day and held up our value. So here's one section. Most of them, we've got a few stragglers for different folks at different places that as we've moved from another broker over to Schwab, we've kind of had different sections of where we've been able to protect for people. But in this case, most everyone, we've got everybody for the most part up here at 150. This is our current stock price as of a couple days ago, 133.60. So there's some value in that increase of premium that we bought our put option for. And you can see how of the $45,000 down on that down day, 37,000 of it was up on our put options. And you add in a couple more of these other ones for smaller amounts of contracts, and we're making a very decent amount of that downward movement on that day. Had a couple more examples. You can see Ford here, similar situation, only down a little bit, but put options up, protecting that value. Boeing down here, and again, this was yesterday. Market was down over 1%. We were down overall 0.3%. Look at Boeing right here, down 10,000 between a few different option contracts to cover those shares. 8,000 we're making up on the way down on that day. That's just kind of a snapshot of one day, right? As stocks continue to move down, we make more and more up, and it gets closer to dollar for dollar we're making up on the way down. So very cool. So we had a discussion, me and Kevin, this morning. We talked about what we're going to do with Apple. We have Apple, where we protected shares at two different sections of 175 and 170. And we have a bit of let's see, try and get, there we go. So we have a bit of profit in the premium of our put options. Let me bring Apple up here. So this was this morning, this Apple. Apple was up this morning, still is about the same price. Stock was up 49,000, which means some of our options were losing a bit of value. But our cost basis, meaning where we first bought those options, is still very much profitable because we have the right in these put options to sell at a higher price. Therefore, we have some value in our put options. So me and Kevin were talking this morning. Okay, we've got earnings later today. We can keep them where they are. We can keep that protection right where it is. We can roll them down to book some profit. We still need that protection in place, some form of protection in place to go through earnings. So we're trying to decide, what do we do? Question from James. Briefly explain when and how is process to sell is done, or are sell of options puts automatic? So to answer your question, James, it's kind of both. We didn't talk too much about the length of these option contracts, but in addition to selecting the strike price where you're deciding what price you're protecting your stock, you also have the length of time that you want that protection, length of time that you want your rights. So if we do nothing and let's say these puts at 175 expire tomorrow and they're quote unquote in the money, meaning the stock price is now lower than where we have the right to sell. If we do nothing, the broker is going to assume that we want to exercise those put options, and they're going to sell our shares of stock at the 175 price. So we'll have booked a profit, and but we would have sold our Apple shares. So if we don't want to sell our shares, we have to do something with the put option. We can choose to exercise it at any time before the expiration, or we can sell the contract altogether. So what we're talking about now is selling that contract. We have earnings today, later. We have a 175 and a 170 put protecting a few different amounts. And just try and get some more things in here. So we have that 175 and 170 put protecting different amounts, and we're trying to decide if we book a little bit of that profit and then buy new put contracts up here or down here at 165 for more time, or another option is to roll them down to 162.50 out to February 18th. 165, we go all the way up to the 24th, I think, the end of the month of February. So those are our two options. Or we can just keep them. So what are some things that we have to consider? We talked this morning, all right, Apple, one of our favorite companies, man, are they awesome at selling phones, and did they just sell a crap load of phones, right? But that's kind of what has already happened. At this point, where are we feeling like there's a good chance that Apple is going to go? Kevin says, well, again, we've had all of our good stuff happen in the last quarter where they sell everything for Christmas. This quarter and going forward, not going to be the same, is it, right? So what do you guys think? Let's talk about keeping it the same. If we think that Apple might go down, what would you do? And here's what happens. If we keep the 175, we're better protected to the downside because it's already in the money. We're going to basically make up nearly dollar for dollar if Apple falls down. if Apple, being a fantastic company, always trying to find ways to help to give benefits to what am I trying to say? Apple's always trying to deliver for shareholders. They come up with some amazing something that allows them to go up, then 175 is basically going to lose. Those 175 puts are basically going to lose a lot more as the stock goes up than a 165 or 162.50 would. So, what are your thoughts? Which one would you do? Would you keep those 175s? Would you roll them down? William, you've been talking a lot lately. What do you think? All right, William says, why not roll them down and book some profit? Okay, William, so what if Apple totally blows their guidance and we could have made pretty much dollar for dollar as it continues down? After we've gone through a Christmas earnings cycle, Apple, everybody's bought their phones in November and December. Typically, historically, our risk is to the downside on this earnings quarter because they don't have, this is the quarter that they've already made their money. Now they're just starting to produce products and focus more on production. And because of that, guidance, or in other words, what their outlooks for making money is going to be lower, at least until closer to the second half of the year, right? So it's not their best quarter. So yes, we could roll it down, but is that the smart choice if we're confident they're going to fall? Okay, so but what about the difference between 165 and 162.50? Well, 165, the ones we were looking at going out further, they gave us the ability to be protected for a longer time. And if we cash in our 175s, that pretty much pays for completely these 165s. It would pay for the 162.50s as well. But the 162.50s aren't going to protect us as well as the 165s. So our bullish case would be close these 175s for profit, buy the 162.50s, because we want to be protected as close to the money as possible, close to where Apple's trading, on the idea that if it continues up, we're not costing as much on our protection. But if it doesn't go the way we want it, it's not going to protect us as well. So what is the bullish case for Apple? Why would we want to, I guess what would be the bullish argument for this earnings for Apple? William says, could surprise with a new product. Yes, typically they don't do a lot of new stuff this early in the year, but sometimes, lately they've been trying to put out new products more regularly to kind of boost things as they hit their kind of less busy periods, right? So that's a possibility, but nothing I know of in particular. So I'm going to say Apple doesn't have a lot of contracts for selling computers to public education. What if they were to do something like that and get a bunch of big contracts to sell computers to schools? There's some things that they could be doing that they could surprise us with. And Apple likes to do that every once in a while. They try to, as I said, deliver for shareholders value. So we've got these two different choices between a 165, 162, I guess 3 different choices. We could keep the 175s. But on the off chance that Apple does something worthwhile, or even that the stock just doesn't fall because they did so well in on their numbers that people are willing to be patient and there's no real reason to be selling off the stock. So what if we bought the 165s and kind of split the difference? 175s and our puts up there at 170, 175, keeping those at this point, we would have to have a serious case of a bearish expectation, or the expectation that Apple would fall, continue to fall. On the bullish case, we have the 162.50s, where we want to pay as little as possible and take as much profit as possible from our 175s. So as Kevin and I discussed this morning, we really couldn't come to a good argument for one extreme or the other, but as it's historically a bearish period or less profitable period for Apple, we wanted to err on the side of caution and book some profit on these 175s, but also not go to the other extreme and expect it to just take off to the upside. So we split the difference. We decided on 165s, totally paid for by 175s that have already become profitable. What does that allow us to do? So it allows us to protect for free, basically, but also if Apple does go up, what can we do? Earnings later today, tomorrow we look at this, Apple's starting to head up a bit, that we're confident. What can we do with those 165 puts? William again. William, you are my favorite friend this morning. William says you can sell them, which is 100% correct. They'll be worth a little bit less if Apple heads up, but if anything we get back is money that we don't have to lose if it continues to go up, right? We can close out our protection, sell those 165 puts, lessen our costs there. Plus, we had booked the profit on 175s, so we've done a decent job at lowering a bit of our cost basis, right? Not going to give us another 100 shares like we might want. In this case, that it goes up tomorrow, but we've done the job of protecting our stock through an earnings report, which is of utmost importance, as those earnings reports can move a stock 20% one way or the other about 80% of the time. That's where they're moving. So that's where we're going to look to protect beforehand. So this was our adjustment. Sold to close 187 shares between a 170 put and a 175 put on various numbers of shares or contracts protecting shares. And then, if I can get this to work, sold those for about $218,000 because we've got a lot of them. And then we went and bought these 165s. Protect us for another week out to February 25th, whereas before we were at February 18th. Gives us a bit more time. And that's going to cost 140. Sold for 218-ish, spent 140 of it. And we are now set for earnings later today. Kind of cool, but just a little bit of a window into our conversations and what we have to look through, and decisions that we have to make, conversations that we have to have to make sure that your shares are protected and that we're benefiting from any pullback in the stock as we've gained value in our puts, and that we're still being prudent and making wise decisions on where the probabilities are for the stocks going into earnings. Guys, are there any thoughts, questions? I know some of you have been kind of waiting as your portfolios come over from the transfer. But, you know, we're working every day to make sure things happen for you and make sure you're protected and take care of you as things come in, right? Any other thoughts or questions, things you'd like me to explain about put options, how we're using them to protect stock ownership? If it doesn't completely sink into you, if it's a little newer still, you have this video that we've recorded you can go back to at myhurleyinvestment.com. If you're not already looking at and checking out myhurleyinvestment.com, we've got pretty much everything. Every webinar we've recorded right there, and you can go back and see it and refer to it if you need to. Just make sure it's the singular Hurley investment. That has pretty much everything. We also have a YouTube page that has pretty much everything as well that we post the same content to. Hurley Investments on YouTube. But it's a little more organized and everything right there at My Hurley Investment. So seems to be a little bit easier to send people there. All right, guys, that's really it for me. I'm feeling really good about our earnings coming up. I'm feeling good about our businesses. You know, last year was incredibly frustrating to see everything that we have. Well, not everything. We had a few things take off, like our banks, right? Costco. But a lot of what we had just not move the way we expected it to in the time frame we did, right? The good news is we still own these great companies, and there's even more of a probability and more of a chance now that these stocks will head up, as they've gone a year without moving the way they should, all while still making more money. The opportunities we have for Apple with all of their cash to deal with any interest rate issues. Same goes for Facebook. Plenty of cash to deal with those issues, not going to be a problem. They're not so highly over leveraged like a lot of tech companies. We've got our Disney that has, you know, their parks are opening up. They've got their, you know, Netflix lost a bunch of subscribers to their competitors. Who's their biggest competitor? Disney. Disney's looking good, and you know, if they go the same way that Netflix did and fall because lower subscribers, for heaven's sake, the amount of subscribers they've acquired just starting up, as they continue to open their parks, boats, etc., everything's going to be going much better for Disney, and it would be foolish not to take part in the coming months and years of where Disney could be. Boeing absolutely crapped their earnings, did not do well because of what looks like they're taking all of their fees, their costs for the 787, and what it looks like is they're putting it all into one big earnings report to kind of wash it out, start from square one, and get all of those costs out of the way in one foul swoop. Taking orders and delivering planes again and increasing that. I think it was 60% more deliveries this year over year this quarter that they reported. Again, another one that would be foolish not to take part in their way back up. So I'll get off of my soapbox. Thank you guys so much for joining me this morning. I hope it was somewhat helpful to any degree. If you would do me a favor, write any questions you might have down as you, you know, coming days you think about this stuff. You're welcome to email them to me or just bring them up next time. Want to make sure that you guys are getting what you need and your questions answered. But we're trying to deliver some value in our meetings here so that you guys have knowledge in addition to comfort in what we're doing for you. So there you go. No other questions? Absolutely, Jim, no problem. Thanks everyone for joining me. I will see you next time. Kevin will be back Monday, so please join our Monday webinar, and we'll go from there. Take care.